Torsten joins us now for more. Torsten, good morning. Good to see you.
Morning.
Let's build on that quote. What are you tracking right now? What are you seeing?
Well, what's really, really important in this discussion is that, of course, profit margins have been phenomenal in the Magnificent Seven. But what really is critical is that now we need to see profit margins go up outside the Magnificent Seven. In other words, what's going on with S&P 493 becomes very, very critical. Because at this point, profit margins in S&P 493 have just not gone up. So therefore, one very important conclusion and one very important place to look for signs of AI beginning to have an impact is to look at what's going on in earnings growth, profit margins, and overall the health of the S&P 493 as a result of the technological improvements we're seeing at the moment.
Meta also making a call potentially as well that the ROI on selling excess capacity might be higher than using it internally. Does that reinforce some of this message for you?
Well, the issue, of course, is that there is a huge, of course, build-out of capacity and compute, and there will literally be unlimited demand for compute. The question is just at what price, and who will the buyers be, and where is that capacity coming from? And the big picture still remains that AI is a very revolutionary technology. Everyone agrees on that, but the key question now is how long time is it going to take before this shows up, especially in profit margins outside the Magnificent Seven? Because if the S&P 493, let's say that it takes several years before profit margins begin to go up, the question is whether the implicit earnings assumptions in the Magnificent Seven are too high or too fast relative to what's actually going to happen. So that mismatch between are we going to see profit margins, earnings growth go up outside the Magnificent Seven, is that going to come slower, is it going to come faster, is absolutely critical for a conversation about what should the value be of the Magnificent Seven today.
In exactly 1 week's time, as John was reminding us, the big banks begin reporting earnings, and we have the kickoff of the earnings season. There's going to be a lot of discussion on AI and what it means for jobs in the banking sector. How do you parse through what the companies say to really understand what it means in terms of whether they're going to cut jobs or not?
What's really challenging about this is to talk about AI exposure, because there's a lot of different studies already that look at what is the exposure, meaning AI exposure in different occupations. These two studies fall into different buckets of one saying what is the actual exposure in terms of actual AI usage. So this is trying to measure, say, what are people using Claude for, what tasks, and what requests did they get, and therefore measuring and quantifying the actual usage of AI. Another bucket is studies that look at, well, let's theoretically assume what is the economist exposure to AI, and then try to match that with occupations and figure out what is employment in those sectors. And those studies, of course, are what you call more theoretical. So the challenge is that there is not an agreement about what does AI exposure mean. So that's raising all these questions around, well, what does it even mean when we say that a certain part of the economy is exposed to AI? Because there's just not at this point in the studies that look at this a really good way to quantify what AI exposure means. And that means also for the financials, that means for legal services, that means for consultants, that we're having some challenges figuring out how do we even quantify what is the impact of AI. We all know that it's going to make a big difference, but the speed with which this difference comes along, how many people it's impacting today, next month, next year, it becomes absolutely critical when you again think about that company valuations today are the net present value of the cash flows that these companies get in the future.
We're also hearing a changing story, a changing narrative from AI companies themselves. There's a Wall Street Journal story about how the narrative has shifted, at least from OpenAI and Anthropic, from these doomsday scenarios to a future where workers actually keep their jobs, but just do it better thanks to AI. What does that tell you?
Yeah, and Ramp had a really interesting study over the last week that they put out, where they basically looked at what has been the cost and the spending on AI among different companies. And what they did, that they looked at, well, what was the job growth in those companies that had more spending on AI? And they did indeed find that more spending on AI, it actually resulted in more job growth. So one way of looking at this is one dimension of saying what's the actual spending relative to the more theoretical matching of occupations with what's been going on with job growth in those sectors that also have been spending on AI.
Torsten, to your point, to put this all together, this is a potential risk to valuations, which is an obvious market risk. Is it a macro risk as well? In Sintra, Portugal, I believe you were there. Big conversation about this. We've got a story in the market right now that feels like one trade, and increasingly a story in the economy that feels like we're firing on one engine. How much is it one and the other?
Absolutely. It's actually three different things. First of all, it's of course everywhere in markets because the concentration to the AI story is so strong. Think about it. For the last 15 years, the main lesson in finance is factor investing. And now we're staring at one factor that's driving all financial markets in equities. The concentration is very high in AI. You also look at IG issuance, high yield issuance, even venture capital capital, the concentration in AI is very, very strong. So in markets, let's just agree the AI exposure or the AI factor plays a very, very critical role at the moment. When it comes to the economy, also, if you look at actual spending on data centers and energy, if you add up what that contributes to GDP this year, it's roughly about 0.7% out of a 2% GDP growth this year. If you add about 0.3 coming from the wealth effect because of high stock prices, that's also very important. And finally, let's also not forget that the hyperscalers are issuing so much IG corporate debt that this is crowding out demand for US treasuries. Because if you're a bond manager in investment grade credit, you can either buy sovereigns, US treasuries, you can buy financials, that's what you've been doing for a long time, but now you can also buy 700 billion in hyperscalers. So it's not only that it has an impact on markets overall and has an impact on GDP, but it actually also has an impact on demand for treasuries. So yes, the conversation and the panel I was on in Sintra was exactly around this risk that AI is indeed now a more and more prominent factor, basically not only in the economy, but also in financial markets.
What's the consensus on how to manage that risk?
Well, the challenge is, page 1 in your finance textbook, if there's one factor you're trying to avoid, is to try to pick another factor. But the question is, what is that other factor? Momentum? Is it growth? Is it value? Value has some opportunities because it's not growth. So that's why ways of looking at parts of the private markets, public markets, that is value investing, is indeed one place to hide. But it has to be value investing that's indeed protecting you against the downside risks that come along if AI does not deliver in the end.
Torsten Slok of Apollo. Torsten, fantastic note. Great read in the last week or so. Appreciate it.